All attendees are in listen-only mode.
Yeah, hi everyone. This is Brian Coester. I'm the CEO of Coester Valuation Management Services. And today we're going to do a webinar on what you need to know about appraisals in 2014. Um, so hopefully everyone can see my screen. I'm actually at home now. We had about a foot of snow, and it's been hectic to say the least, and a hectic winter. But luckily, we're all safe and sound. So, nonetheless. Um, the goal of this webinar is just kind of give people a basis. I read published an article, um, maybe early 2014, late 2013 about, kind of what you need to know in 2014. And that, I got a lot of questions, I got a lot of emails, I got a lot of, really a lot of information and requests about what you need to know, what you need to do. Um, and the goal is to go over that, maybe go into a little more detail, and maybe if we have enough time, um, do a little Q&A. But the goal is at least for this level, is to start with just a baseline of really kind of what you need to know in 2014 about the appraisals. The first thing, obviously, is compliance. Compliance gets real, but won't be full force until 2015. And the reason I say that um, is really because the regulators are trying to get the lay of the land. A lot of the stuff implemented by the CFPB, a lot of stuff implemented, by state legislation, was great in theory, and then the practicality of this uh, is not as easy to deal with. So you look at something like just something as fraud detection prevention, UCDP compliance, audit processes, or the validation of accuracy of the appraisals. Um, it sounds great in theory, and then when you actually start saying, okay, how do we implement this? How do we get this down to a daily agenda? Something as simple as vendor management and things of that nature. It really is hard to do, and so what you're going to see is in 2015, what you expect to do is the valuation of the accuracy of the appraisals, meaning they're going to want you to really look at how accurate these appraisals are in context of other appraisers. The base Fannie Mae FHA checklist is fine. Most companies store that. Most companies have that. But the problem is that what the regulators are finding and what people are finding is that most lenders are leaving that QC process to the AMC, which is okay as long as it's documented and as long as it's thorough and as long as it's accurate. But they don't want that to be just the excuse. So I mean, if you look at the old model where you had a local savings and bank or a local loan company, and they had a chief appraiser that would sit there and review the files that came in from all the appraisers, and he'd look at them, or she would look at them and make sure they're accurate or not. And then the ones that weren't, kind of get put on the bad list, or get denied and revised, and the ones that are get closed and pushed through. And that kind of old block and tackle is not necessarily, they don't want you to get that far from that. And so they're really expecting a lot of these tools that have come out that are, give a score to the appraisal, or look for this or look for that, don't really have to do with anything of accuracy. It just, it tells you if it didn't meet the guidelines or not, tells you about some basic stuff. But other than that, it really doesn't. And then what they're going to do is they're going to want you to drill down on the file by file basis, not 100%, but some type of percentage sampling, and make sure these things are right. That could be a field review. That could be, a desk review. It could be another full appraisal. But they're really going to want a mortgage bank or mortgage lender to make sure that those things are right, because not just for Fannie Mae, UCDP, and it seems like now that there's so many different entities that are looking at this, you would think that they just kind of trust you. But on a state by state basis, to say that the loans done in the state of Maryland and the appraisals done in the state of Maryland are accurate, um, that the OCC now is coming down on the appraisal piece as far as, making sure that your internal controls are in place to make sure these appraisals are accurate, and that you do have a really good audit process on a file level basis in place to prevent fraud, to detect fraud, and to also, bring up a level of suspicion when it comes to certain things like frequency of appraiser used, things like the same conditioning coming over and over again, things like if an appraiser is doing an exuberant number of reports, things like if the purchase price is always hitting the sale price, or if it's always, they want you to be able to track and detect things, and specifically just not only track and detect things, the big thing that a lot of the regulators, and kind of the key word that they're using a lot, is compliance management system. And what that compliance management system is they don't want you to have a policy driven company, meaning documents on pieces of paper. And the reason they like that, and everyone should have that, but the problem with a policy driven problem with a policy driven system is that you're stuck with a lot of manual detection and not systematic detection. So if an appraiser, if every single one of John's appraisals come in $20,000 above the purchase price, and just every single time, and not only that, but his adjustments are a higher percentage, how are you going to be able to detect that automatically, is what they want to find out. The UCDP is starting to implement some of that stuff where Fannie Mae, but that's at the at a very big brother level. We're trying to look at it more, not necessarily just at the big brother level, but really with an internal control level of the same appraisers being used over and over and over again, and the appraisers are coming from all over the place, or the appraisals are really good, and you have a reason for that, but you need to know the goal of just trusting it's over with. The whole fraud detection is something that they're going to be looking at, as well as just level of suspicion. And when I look at level of suspicion, think about it from a common sense standpoint, meaning some lenders are very, very particular, about their appraisal process, and the regulators are really trying to figure out why. Meaning the goal of is the appraiser is a licensed certified appraiser. You should do the QC. You should do everything that is required on an audit procedural standpoint. But at the same time, you shouldn't be so hell-bent for leather on these three appraisers only doing my work. And that level of suspicion, I know some banks that that I've heard about, have gotten, I wouldn't say sanctioned, but they've gotten letters of recommendation for removing the appraiser panel completely. That they should not have branch-specific appraiser panels, because I know some of the people who manage the process in-house. The regulator says, come and said you need to move this off-site. And the reason is because simply that level of suspicion of, okay, this is an independent appraisal. You have somebody right here ordering the appraisals from the same three appraisers. You have no technology. You have no processes in place other than documentation, and it's just not a good setup, to say the least. Another thing is, and kind of moving forward, would be the AMC state licensing. So, per Dodd Frank, this will continue, and you're going to see every, by the end of 2014, you're going to see almost every state is going to have AMC licenses. Many of them are basically identical, with identical verbiage. I mean, there's actually a meeting that most of these regulators go to in DC that shares a lot of this information. that shares a lot of this information that they kind of, I wouldn't say copy and paste, but they generally copy and paste the same information over and over and over again. And so they look very similar. There's a little variances um, when it comes to fee disclosures, controlling persons and compliance managers. Like in Utah, the person who assigns the appraisal has to be USPAP certified, or the person who's the vendor manager. And then there's controlling person in certain states. You have to have an appraiser on staff, like in California and in Nevada, and there's a little variances amongst them, but they're generally the same. And just expect, for the most part, um, that to continue. When it comes to customary reasonable fees, and this is a big topic um, amongst the appraiser in industry, and I wish I wish I had a good answer for you, but there's nothing really going on. This is something that I think was, when it was put in the legislation originally, the original intent is, and I think this gets overused too to a certain extent, but the original intent really didn't have anything to do with the appraisal piece or the appraiser itself. It was more um, it was more along the lines of just making sure that the term customary reasonable is used a lot in legislation, specifically when it comes to regulating industries of just, they don't want the borrower paying $5,000 for an appraisal that should have cost $450. They don't want the borrower paying $500 for an appraisal that should have cost $200 or for a drive-by. So they wanted to be reasonable for their customary reasons. That got put into the appraiser's fee. And personally, I do agree that there should be some type of issue. There should be some type of legislation around that. The only state that I really see them actually put a fee, and there probably be, there might be other states, would be New Jersey. In 2012, they released something that an appraisal fee should be $350 and no more than $450. Which to me was, I mean, you don't even, to a certain extent, when we had our legal team look at this, you don't even have um, to a certain extent, there's things around that that it makes you so you don't have to follow that either. But the general gist of it is they did come out with something, and I thought it was really bad. And the reason is because obviously, from an appraiser's perspective, a range that tight, especially and then on top of that you can go around it, just doesn't make sense. I mean, there's going to be appraisals in New Jersey. What about $1 million property? What about a waterfront property? And the fact that it should be 350 to 450, they don't get into specifics as desktops or anything that granular or that specific. The conflict to this whole thing, and this is something that I'm actually starting to try to work on, is the whole bias that the appraisal fee is paid outside of closing. It's an upfront cost, and to a certain extent is considered almost like an application fee when it comes to the borrower. I mean, they've got a barrier for entry on a refinance that is it worth the $450 or $550 or $650? The solution. And then there's also a competitive. I'm sorry, let me backtrack the conflict. There's among lenders, there's a competitiveness of my fee is lower than your fee type scenario, and that's very real. The appraisal industry doesn't like to think of it that way, but the reality is that you're a service provider, and just like Comcast or just like anything else, and or an internet service or a lawyer or anything else, and it's subject to competition. And lenders want to get these deals done, and one lender says it's 350, another lender says it's 450, and another lender says it's 550, and the borrower says, I'm pretty assuming they're all going to be all the same. I'm going to go with the cheapest one. Just like certain lenders, charge a lot less percentage-wise for fees. So it is what it is. We just something we have to deal with. I proposed that the fees should be regulated just like the title industry, which the fees are set at the state. So there's really no debate amongst anybody as far as um, as far as how much the fee is. It's a tier structure, um, and it just is what it is. It's set by the state. That would eliminate the conflict amongst competitors, and then it would allow at least the appraisal industry to have a voice. Until then, it kind of is what it is to a certain extent, but they want appraisers to be paid a customary reasonable fee. Most states have come out and said that they want you as an AMC or you as a lender to determine how you determine the customary reasonable fee. But there's always that innate conflict of there's only going the lender's only going to pay so much, and you have to deal within a competitive environment, and so regardless of what solution you have for that, it's the appraiser is getting paid less than let's just say the AMC is charging. The whole separation in a fee plus model, which I'm very for, which is just simply, the appraiser says whatever it is, and then, the AMC charges an extra $100 and just calls it a day. It's very hard to implement. A lot of lenders, if you really look at it, a lot of lenders that, have wanted to implement it. And I'm not going to name any, but they have. And what happens is they really get to it, and once they start trying to do it, they back out of it. And the reason is because the fees vary so much that it'd be hard to assign the files and have any basis for why this one charged, why this one was $500, why this one was $400, why this one was $600, why this one was $300, or this one was $450 in the same market. And so what ends up happening is you look at that and they say, well, we can't have these, a borrower paying $300 for one file and then $700 for the other file in the same market. We're going to get killed by the regulators on why there's a huge difference in fees. And so let's just set a fee and we'll go with that. And so it comes back directly to that. So, it's out for debate. I hopefully there'll be, and I'm working on some stuff now that, if you can get the MBA to kind of agree that this needs to change, and support that, there could be something pushed through relatively easily. Borrower appraisal delivery. Borrower must receive a copy of the appraisal. You need the ability to track, monitor, and store how the appraisals are delivered. So that's really just kind of is what it is. The regulation, the CFPB has come out and said borrower needs a copy of the appraisal and all valuations along with that. So not just the appraisal, but any AVMs, any field reviews, any desk reviews, anything that has to do with the appraisal piece, the the review that was done, or a commentary, or all field review, all that stuff. Borrower needs a copy. The basic, we're going to email it to them. It's a little too risky for me. And the reason I say it's a little too risky is because, who's to say that the borrower just comes back and says, I didn't get it? And so I always tend to lean on the side of, believe but verify. And so, we built a really good tracking system that, monitors and tracks and stores how it was delivered and when it was open, the number of times it was open, the IP address it was open, who entered the borrower's email information, and then working on now an integration with a print shop to they don't open it within a couple amount of days, that it's automatically going to go to the borrower, and all the documentation is going to go. So that's a reasonable solution. There's other solutions. I know Encompass has something that you can use. I know some of the LS systems have something that you can use to verify that they've gotten it. But just think about, from just a generally speaking, for 2014, they're not going to take, we emailed it to them, without some type of tracking, monitoring, and proof that they got it. So just think about that. Joint ventures and third-party interests. So if you own an AMC or have partial interest in AMC as a lender, sell it. sell your shares or close it. There's about 500 reasons why, but general rule is CFPB doesn't want you or anything, do anything but your main business. And there's a good rule for that. I was with, gosh, I can't even remember her name now, but somebody from the CFPB over in DC, maybe about 2 months ago. And the whole thing of third-party joint venture interests is something important to me, obviously, and then just something that a lot of the title. My brother owns a title company, and so he was wondering about that. And I really asked her. I really spent like an hour, drilling down all the different scenarios, and she kind of bottom lined it, which was they based all their decisions off of data. Okay. And so when there's data-driven decisions, she says that she cannot, for the life of her, and for basically everybody in, that have come to her and proposed, that this third-party interest thing calculated is in the best interest of the consumer. Basically, nobody has been able to come to her and say, here's data that proves that it's in the best interest of the consumer for a lender to own the title company, or it's in the best interest of the consumer for the lender to own the AMC. Okay, and that's the way they look at that. And so if there's no data that says it's in the best interest of the consumer or it's in the best interest of the lender in the consumer, for the lender to have a shared interest or partial interest in an AMC, then they're saying, okay, well then why do you have it is the great question. And so we can make money off of it is usually, kind of the answer. And they say, okay, well, if you make money off it, then you need to disclose that you're making money. It's going to need to be calculated the APR. It's going to go up against the 3% rule. It's going to go up against everything else because you're really just in it to make money. And so it's just something to really think about. I would say the general gist of it is that most regulators and most state agencies and stuff won't just come out and say you can't do this, because when you say when you blatantly say that, what ends up happening is there's all these little scenarios that people come up with. Well, what if this and that and this? What if this and that and this? What if my friend's cousin, this, they kind of these people come up with these million different scenarios that makes it really hard for somebody to say never. But what they do is make it really complicated, so that if you do want to do it, you've got to fit it within this little box that's so tight that it almost becomes not worth doing. And then also that they create so much exposure and ask so much questions that you really don't want to do it. And so they kind of, for lack of a better word, legislatively bully you into basically not doing it because they just create too many questions. When it comes to title, when it comes to appraisals, and I would say specifically more appraisals, and the reason is because the title is pretty generic, pretty simple. There's not that many things that can go wrong. When it comes to the appraisal, if you own the appraisal company, there's always that overlay of, and you're making money off of it, there's always that overlay of, oh, you're going to make sure these deals get going through. You're going to, there's always that question in the back of your mind. I remember, as an appraiser, every time, I would go out and do an appraisal, and I'd meet a realtor, I'd meet a builder, and there was an investor who was renovating a property. In the back of your mind, you kind of always think, like, they're not going to get me. They're not going to scam me, or, I'm going to make sure everything's right. And I think that's somewhat the spirit of things when it comes to the regulators. When they see that, convoluted, you're really involved in the appraisal process and you're owning an interest and stuff, they don't look at it as like you're interested in this process and you're just committed to the excellence of the appraisal process. They look at it more like, what's going on here? Why are you even involved in this? You shouldn't have anything to do with this type of scenario. So now, if you're maintaining a process in-house, and I'm not against that at all by any means, what I would say, hire a chief appraiser as a licensed certified appraiser. Make the office 3 or 4 miles from your office. Invest in a good software system. Set it up as a separately run entity. Get all your licenses and don't run out of profit. I mean, you can make a little money. You can make some money from the appraisal to cover your expenses and call it a day. I've seen some really good setups personally. I mean, some excellent setups. Actually, I was just in California earlier this week, and I was at a lender's office that had, actually 2 lenders' offices that had their own, they had a combination of a off-site appraisal management company that was owned by them. They had a chief appraiser that worked for the company, and they had their like a Realcy or something like that software system that they used to manage the appraisers, and then they used AMC's kind of within that on a manual automated rotation. He managed the panel. He managed everything. It was kind of every 4th order to a certain extent, or every 5th order in specific counties, and it was just a really good, clean setup, run as a separate, complete entity. They had all their licenses. They made a little money off the appraisals, but generally speaking, it was a pass through for the most part, and it was a really good, clean setup. 99.999% of the state regulator would be totally okay with the general gist of that. Meaning you have a well-managed, well-oiled machine that has the software technology, people in place to execute this right. They also have the volume to do it too, which is another factor. But when you look at what most companies have is nothing more than one person who sits there and orders the appraisals, and that's it, and they don't do anything else, and they're right next to everybody else, and it's just a little too close for comfort, because they're always thinking they're one bad decision away from one bad decision away from having a serious issue. And regulators are really looking at that. So, previously this may have been okay, but just think about that when it comes to, how your company's set up, or how you want to see the industry set up. The chief appraiser is definitely making a comeback at the lender position. I would say 4 or 5 years ago, or maybe that's 6 years ago, you really didn't see that. Now that chief appraiser position is becoming more and more prevalent, and I think it's a great thing for the industry. I'm just glad to see that. Glad to see that come back. Branch-specific appraiser panel. The rumblings are starting. I had a conversation with somebody at the OCC maybe a month ago, and the rumblings are starting, and the reason is because they don't see the value of having branch-specific appraiser panel. The gist of it is it shouldn't be controlled at the branch level. It should be company-wide. So have a company-approved lift. Have a if you're ABC Mortgage Company, ABC Mortgage or ABC Bank approved appraiser panel. Perfectly okay. Perfectly acceptable. You have specific regulations, specific training, specific overlays they have to go through to become on the panel and get approved with your company. And that's it. The branch specific one of, I've got 5 branches in Charlotte, North Carolina. And we used to work with a company like that, and these 3 appraisers are okay for this branch in Charlotte, but it's these 4 in a different branch in Charlotte, and these 5 in a different branch in Charlotte, and they're all in Charlotte, and all these appraisers cover Charlotte, and you got 12 appraisers or 10 appraisers that cover Charlotte that don't work for any of each other's branch. It's like they're like, no way, because technically, if they're all competent to do appraisals in Charlotte, and there's no other reason than that they don't do, they get approved with those branches specifically, they're thinking that it's just because this is loan officer directed or realtor directed, or there's something else other than it being just pure, we're doing this for the appraisal. So just go to it company-wide. Company-wide, you got 10 appraisers in Charlotte, and, it's or 7 appraisers in Charlotte, and that's it, kind of thing. It's a lot cleaner, a lot better, a lot easier to manage. And, when you remove an appraiser, you add another, and it's just really simple, clean, no big deal. That's something I would say, start the process now, and then by 2015, go company-wide. And the reason I say go company-wide by 2015 is because I think you're going to start seeing things getting cracked down on by 2015 when it comes to things like this and those specific appraisals. Okay. If you use an AMC and your AMC doesn't have its own software, I'm a little biased on this, but the SAS model for AMC is really hard to be compliant. The reason is because not having your own tech team makes it really, really difficult. And this is just from personal experience. So this is not like, theory, or this is not like the rules of the world. This is just personal experience I've had. When lenders or other AMC guys that I know ask me what I'm doing for this, what I'm doing for that, or if if I look at competitors of how they implemented certain processes and business processes, what ends up happening is you really can't, or I would say can't. It's really difficult to implement a new procedure, a new policy, new state-specific regulation. Something like as simple as, in Utah, the person assigning the appraisal must be USPAP certified. Right? So it's really simple. And so, if you don't have your own software and Utah comes out with its state regulations, you got to wait until until that software company enables basically a certification process at the user level that an admin can go in and say he's taken the USPAP class and he's now able to assign appraisals in Utah. Or you would technically have the whole company take Utah, assigning the appraisal and USPAP certification, which is a little unrealistic as you get a little bigger, or they just kind of ignore it, or they read a policy. And I would say most people do the procedural documentation. So, they write out a policy. ABC Appraisal Management Company, only uses, they're USPAP certified people to assign appraisals in Utah. And that's fine for a little bit and temporarily, and they expect that. But when it comes to actually having controls in place, and they say, show me how you prevent a processor, who works on the other side of the office from assigning appraisals in Utah, and you're going to say, well, here's this document here. That's not enough. And so it's just a little risky. And so there are some good softwares out there. There are some good softwares out there. There are some, some good things that they're working on, and you can really, if implemented the right way. And from an individual lender using it, I'm a lot more comfortable with. But just from an AMC model, because you're dealing with so many different clients, and each client has their different business process, and each client has their different procedure. It's just so difficult to do that effectively. And just something to think about. UCDP and ULDD gets real. So what the GSEs are doing with your appraisal data, I know we got a lot of appraisers on this, is they're scanning, monitoring, and tracking it. And so this is the definition of Big Brother, like beyond anybody's, kind of comprehension to a certain extent. They're looking at, I did the appraisal, You did the appraisal in 2013, and you said that 123 Johnson Street was a C1 for condition. And then, you know, 6 months later, you used Johnson Street and you put it as a C2. That's a bad example because it would be new as a C1. So it's a C2 and then use it as a C3. They're going to know that, and they're going to know that C2 should be all the way across the board. And it should be the same every single time, almost to a certain extent, within a certain time frame, especially if you're doing it. And they're going to know that, and they're going to track that, and they're going to store that with the idea of they're going to leverage that in case they just need a reason to push something back, or they need a reason to, file a lawsuit or something like that. They're going to have they literally have 9 billion appraisals scanned. That's just absolutely incredible, the amount of data that they have. To come back and say, here's 20 reasons why your appraisal's bad, or here's 10 reasons why. Now, it probably won't actually get that bad. And, I don't know how good Fannie and Freddie are going to get at enforcing this stuff, but I would just say it's going to get real, and they're going to want, not only appraisers to be held accountable, but lenders to be held accountable for having the proper controls in place to making sure things are accurate. Where, if two appraisers do the same appraisal on the same property within a certain time frame for the same lender, and they have 2 different condition types, they're going to want you as a lender to know that and catch that before it gets to them. And if you look at it from an appraiser's perspective, they're going to want consistency. So they're going to want you to work within your market area that you've worked and you always work. Now, you can go to a new market, but when you go to a new market, stay in that market, and they're going to know this, and they're going to be tracking, and they're going to be monitoring it to make sure that they avoid any type of fraudulent activity. So if your cousin asks you to do an appraisal in Miami and you're based in Orlando, and just because you have your Florida license, you decide to do it, I would avoid that unless you always do appraisals in Miami, unless you're planning to move to Miami. Because what's going to happen is they're going to come back and check and see, like, you've done 50, 500 appraisals in this one little corridor, and then now you're going into other areas, and it's just not something I would say is considered going to be acceptable, and for you in a business practice to do long term. So just ULDD and UCP are really real. USPAP changes. This is kind of simple. They made a change to the ethics rule that requires an appraiser to disclose or any current or prospective interest in the subject property. You can read that. And then competency rule. So just some things, some small changes. Solar and electric. So this will begin to make a notable difference in value of homes. Appraisers are always a little behind, and I always thought, that and the reason they're a little behind is because they're waiting to see how things kind of pan out. Because just because it's fad, just because people think it's something great, that doesn't necessarily mean it is. The appraisal industry, I wouldn't say they move slow, but they definitely are a little slower than what most people would want, and there's a good reason for that. And the reason for that is because they're kind of unemotional. They say, "Give me the data." Give me the data that shows it's actually worth more, or give me the data that shows that you know um, that it's going to make a big difference. And we're starting to get some in certain areas that it does show that it's actually making a difference. Colorado and Texas, um, you're starting to see a increase, a significant increase um, in the fact that with solar versus not solar, um, that it's actually going to make um, a difference in the value. Some are bought, with new construction, they're bought. With new home purchases, they're bought. Most are leased. And valuating that lease, it's usually a 20-year lease. I thought they should make it a 30-year lease and to go with the mortgage, right? So you have it for the length of the mortgage, because then it's really easy. But you're starting to see this come up, and I would say, as an appraiser, when you look at some of those, like Colorado, they're sunny like all the time. Uh, I'm sure it's very, very specific, but from a lender's perspective, you should start seeing that, the solar and the green and the energy efficiency and all that, which is great, is really going to start making a difference in the value of homes. And I would say by 2016, 2017, is going to make a really big difference, because you're going to see, the stuff that they're working on for solar power is really just incredible. Where you'll be able to put something the size of like a pool table on the top of your house, that'll be able to power your house for weeks. And have a little battery unit that's like the size, of a like a trunk, that will be able to power your house for a very long time. So it'll eventually get there. For now, but it's starting to become a factor. Previously to this, in 2012, 2013, you really almost got nothing. You're seeing significant strides now. There's something along the lines of in Colorado, that the average home price pre solar was like around 255,000, 260,000, and with solar it's like 280. But the cost of the unit's only about 20 grand, or 22,000. So you're seeing actually a spread there between the cost and the market, which is really good for the appraising, meaning there's some value above the cost um, for the implementation of the system. Risky mortgage appraisal documentation, you'd be doing this anyway. This is just basically, high risk mortgage loans secured by a consumer that a certified appraiser must be used. That a certified appraiser must be used. No, okay. That a certified appraiser must be used for a high risk loan mortgage. Hold on, my son goes. And so this is something relatively simple. A lot of these new rules and regulations were considered almost best practices beforehand, but this is just a requirement that they must use a licensed or certified appraiser. So changes at Coester VMS. We're really starting to build some great things in technology. We're releasing and updating some of our air products, which is automated appraisal review. A lot of the data and technologies is modeling off of the same what Fannie and Freddie are doing. It's going to be pretty incredible when it's all done, and we're definitely excited about it. Reporting on every data field. So as a lender or an appraiser, you'll be able to go in and report on every field, as far as reconciliations or adjustments or values or things like that. With the idea that we definitely want to get a little more specific. If you're doing QC on an appraiser, or if you're looking at something You want to make sure that every single appraiser is as far as adjustments or percentage of adjustments, or you want to look at the percentage, the average adjustment for a two-car garage in the zip code. That's something that is available and should be available at your fingertips, specifically when you're trying to identify trends or fraud on specific things. If, for instance, you have a property in a certain county and the appraiser makes a comment, this is 10 miles for a comparable distance is considered typical within the market. Well, if you've got 70 appraisals that say that it's not, then that's a very valid data point. Direct deposit to vendors, and then integrations and update to integrations. So in Encompass integration, we have a custom update to the existing that we're releasing in March. So we have full control of the interface. We bought the software developers kit. This is going to be pretty awesome. Reverse Vision and Baydocs, which are two reverse mortgage loan origination systems. We actually do a lot in the reverse mortgage space that we'll have. And then a Really See custom update to existing, which is really exciting. We have a couple customers that use us through the Really See platform, and it's a great way to, if you're doing a high volume and managing kind of a whole bunch of different processes, it's a great way to use it, and we've updated that. And then the web services expansion, which will be able to send in almost every appraisal field or data field back directly to anywhere you want it pointed. To anywhere you want it pointed. So if you have any questions, you can email me directly, bcoester@coestervms.com, and my sun is up, so it's going to be hard to continue this. I don't know if we have any questions. Let's see. If you have any questions about this, I thank you guys for connecting. But if you have any questions, just email me. I apologize because of the snow day. It made things a lot more difficult to do. But if you could just please email me, bcoester@coestervms.com, and I'll be happy to get back to you. Thank you so much, and have a great February.